So, hi everyone. My name is Hezzy Jones. Welcome to 2026. And this is a new space, and I call it system malfunction. And I created this specific Substack to shed light on many of the systems that we have today. Their inherited societal beliefs, values that shape much of the rules, processes, procedures, and laws that we have today that we call norms. So many of these systems aren't working, at least not for everyone. And so the system is malfunctioning. It's exposing a lot of the glitches and the mechanisms that we've trusted so long. So this is why I created this channel. And today we are going to talk about the AI tech bubble. And there continues to be some kind of speculation about the state of technology today, specifically in generative AI. OpenAI, Anthropic, Oracle, the VCs that support these companies, as well as NVIDIA, the supply chain, and whether or not we're actually witnessing an impending bubble burst. So, I mean, let's face it, the technology isn't necessarily working. Since 2023, Sam Altman and Jensen Huang have been touting the need to invest in more compute power and to support $2 trillion they already spent on LLMs and to accelerate their growth, let's spend another 3 million approximately in data centers. So this has led to a massive debt among many of the hyperscalers like NVIDIA, CoreWeave, Oracle. Now OpenAI announces that ads are coming to ChatGPT. And the funny thing about that is that with Netflix, they never monetized through ads until much later when they realized that they couldn't make money specifically on subscriptions. But I digress. We're going to talk about that later. AI also has promised that it would automate many jobs, and Goldman Sachs predicted a few years ago that over 300 million full-time jobs would disappear. And that didn't happen. 2025, there have been numerous studies that came out that indicated that it was not AI, but a combination of inflation surge driven by the pandemic, and the Fed rate hikes that actually increased the cost of capital and made it impossible for a lot of these companies to actually hire even some of the juniors who they say were the ones that are being replaced by AI. So things like that have been happening. We've also seen 2025 to be a year when the disruptive technology was supposed to take off, but McKinsey had basically said, no, 62% of enterprises are still pretty much in a place where they are experimenting with the technology. And we know the tech isn't working. It's ripe with errors. It's great for next word prediction and pattern recognition, but it needs multiple prompts to actually get to an outcome that people want. So we're going to talk about all this stuff. It doesn't necessarily work, and yet there is this belief that it's going to be the thing that's going to change mankind. It's going to get us to AGI. So I'm excited to be joined by Greg Crennan, who is a chief marketing strategist and founder of Coastal Journal, who has a great understanding of macroeconomics and forensic accounting, and he will help me shed light and provide insights into what's happening today within the tech industry. So, Greg, you cover the AI bubble and you've also covered some of the AI stocks, and you're going to help me surface what's really going on. So, let's start with you, and welcome, by the way. Can you tell me a little bit about you and your background, how Coastal Journal started, and how you actually analyze the events that are happening today?
Yeah, so I've been doing work in the financial sector now for 7 years and working my way up. And as a chief market strategist for Consultants, I do a lot of work as far as research on, balance sheets, discounted rates, interest rates, economic modeling. And over the past couple of years, I basically was getting fed up with the information that was getting put out through a lot of the legacy media financial news networks. And I felt like none of the financial news really helps the average person. And so, and this also can be boring, it could be dull, it can be lame, and it doesn't really give much use to anybody who's trying to learn, who's trying to get a better understanding how to manage their finances. And so that's where I got the idea of the Coastal Journal. And basically, it was to give information and analysis to the general public from Wall Street to Main Street because the amount of misconception, I don't want to say misinformation because it's more of like a misdirect or a misconception of information or twisting of words and headlines and leads people to maybe lose a lot of money or lose money, and people don't really understand our monetary system that is ongoing. And so, people, when inflation hit 9% and then came back down, the media cheered because the inflation rate came down, but prices were still rising, and no one wanted to really address or explain about the like compounding effects of inflation because we never really had over the past couple of decades 10% inflation readings on an annual basis before up until recently. So that's where the idea of the Coastal Journal came in. And then what happened was as the AI mania happened and basically became a bubble over the past, year or two, is that looking into the financials of these companies and looking into how you can continue to sustain growth, whether or not it's organic or artificial. And a lot of that information can be found on balance sheets. And I felt like that would be a great way that I can help people understand a lot more of what's going on with companies, how CapEx works, debt levels, demand, whether it's organic or artificial. Because, if you're invested in these companies, you should really understand what's going on and your risks in case it does go south.
Okay. And I think anything else, because my husband's also an accountant. He said the numbers don't lie. I mean, you can do the best as you can to try to hide, but cooking the books from this perspective, it would be problematic, especially from an investor perspective, I would assume.
Yeah, absolutely. And so also the issue is that some of these companies, what they have learned over the past couple of years and even decades, is it may not actually be illegal what they're doing. So they've really found their ways of pushing their limits all the way to like that red line before crossing, illegal activities. And so there's that fine line is really important because you rather be in a company that's not on the thin line where it can very easily be considered illegal or, manipulated or artificial. And you really want to be on the side where all the data is real and organic and you don't have to worry about one-time counting gimmicks.
Okay. So I'm going to ask you a few questions about what's going on today. And have you heard of Cory Doctorow?
Yeah.
He's a famous journalist. Okay. So I've followed him for many years. I think he was the one that coined the enshittification of the internet, right?
Yeah.
And so he's a big advocate for digital rights and an open internet. I happened upon an article where he said this. While you are growing to domination, the market loves you. But once you achieve dominance, the market lops 75% or more off your value in a single stroke if they do not trust your pricing power, which is why growing stock companies are always desperately pumping up one bubble or another, spending billions to hype the pivot. So he claims that the primary goal is to keep the market convinced that your company will continue to grow and to remain convinced until that bubble comes along. So, in your view, based on everything that you've been studying with the big tech and the finances that are happening, are they trying to convince us of this massive growth that's coming because of generative AI, and how is it manifesting itself when it comes to these valuations?
Well, they have to because of their capital expenditures or their CapEx, meaning the amount of money that these companies are putting into the current AI technology or apps is that they're spending tons and tons of money. And so the issue is, okay, well, you had a lot of free cash flow and now you're spending all your free cash flow. And eventually, investors are going to say, well, where is your ROI on this CapEx that you're spending? And now the issue is no one has really come up with a way of showcasing how they're going to be making money off of it. And so the issue now is I think that's going to be the real, it's already kind of been the story towards the end of last year. It kind of faded because everyone's now waiting for the upcoming earnings that are going to be coming out. But meaning, where is your return on investment on that CapEx that you've spent in 24 and 25? And we're starting to see recently in last year or towards the end of last year, where now investors are concerned that, wait a second, we may not get our money back.
Okay. So I was reading this on your blog on January 2nd, and you posted this warning about the stocks. And Palantir had come down 4.5%, almost Tesla 0.48%, NVIDIA 1.49%. Can you explain what's actually happening with the stock prices of these major tech firms, and then how you use PE ratios as indicators for growth and investor confidence?
Yeah, so I think right now I call it like the plateau phase. So you're having a lot of volatility in the markets. Eventually, it's going to be decided either one way or another, which one way would being to the upside and one way being to the downside. And so right now what we're seeing basically over the past, say, 3 to 6 months is things go up 10%, then back down 10%. And really, if you look at the price of NVIDIA, it's been the same price as it was 6 or 7 months ago. And so you have it on a more of a longer term trend right now is just plateauing, meaning some weeks it's up, some weeks it's down, and really it's the same price it was seven, or the value and the price of the company is the same it was 7 years ago. Now you have some companies like Oracle though. Now back in September, when it was really interesting to me because at that moment after they reported earnings in September, their stock was up in the after hour session like 20%. And I was like, this is a big mega cap company. I've seen like five and maybe close to a 10% after hours move before, but a company so large going up 20% after hours, immediate red flag came up to me. And that's when I looked into their earnings statement and found out that they were losing money and their debt was going through the roof. And so to me, I was like, wait a second, why is this happening? And then looking into everything, exposing their debt issues, and then all of a sudden, from that moment in September, the stock's down, I think 30 or 40% or something along the lines of that. And so we're starting to see investors are questioning the value of these companies and if actually possibly there is default because now you have like credit default swaps, which are bets against the company going bust, are rising. And so, and why are they rising? It's because when you do the math, these companies are spending so many billions of dollars that they're not just going to be able to start charging something that they don't know if they're going to get a return on investment on. And
Okay.
that's the issue right now. And so like basically we're on this like plateauing trend. It's like a lot of people are waiting to get more data, more information. Guidance is going to be very important. I know as we're on this call today, Intel just came out with their earnings and the stock is down, I believe, after hours. And this is going to be the question or the story, I should say, going into 2026, where investors are now going to say, where is your return on this AI investment that you're doing? Because
Mhm.
now going back to your price to earnings ratio, their price, you're paying, investors are paying such a premium for companies to grow their earnings, which means higher revenues, higher profits. And if those revenues and profits don't materialize, well, then that means the companies are very overvalued at today's prices, and the market will correct that overvaluation, and it could be very brutal in the process.
Okay. The one thing that I'm realizing, and this is related to their pricing and their financial performance, is that the more people that use AI, the more costly it is on their end because they haven't quite figured out a way to price it so that it's affordable to actually do a prompt. or an inference. Is that
That's
right?
actually a great question or a statement because also some of the models already are being more efficient. So if the current LLM models that we use, if they actually become more efficient and the cost and the usage of compute power actually declines, then we actually don't need more data centers out there, or the amount of data centers or the amount of compute power that we already have is already bigger than what we actually need because now companies are working on scaling and shrinking, and that is actually happening. I actually did a report on that towards the end of last year, and it was when the Chinese LLM DeepSeek came out, and they were basically able to function at almost the same level or at the same level of Gemini and ChatGPT at a way, way more efficient cost. And so
Mhm.
it's not if these can be more efficient, it's there already are efficient models and they'll be more efficient going forward because as companies build their own, they want to have efficient cost. So if that's the case, well, we wouldn't need more compute power because people are already shrinking the models down. And then the other thing is we're going to be changing how we're going to be doing this as far as how models interact with data centers and on compute power.
The one thing I will say though is that when we get efficiency, it doesn't necessarily mean costs are going to go down because when you get efficiency, you also get commodification,
Right,
which
right.
means that you increase usage. And if in fact that were true, that you don't need the data centers, then and DeepSeek is in fact using it at a more efficiency than let's say OpenAI, then why is the Chinese government putting billions of dollars into, underwater infrastructure to support the build of more data centers? So that I think we have to figure out whether or not that actually rings true. The reality too is with data centers, they're going to compete for the same water resources that we are. And 3% of the world's water, which is they call it potable water, drinkable water, is the exact type of water that they need in order to cool down these systems. So that is going to be another constraint in the future, and I'm sure it's going to be like a financial burden on the other side. So let's talk about the circular financing because I'm assuming that what's happening to Oracle, there is a story underneath that, and it's actually not only happening to Oracle, correct?
Yeah, correct. The circular financing with AI is huge. And so you have so many different companies involved in it. And basically everyone's taking money out of their left pocket and putting it in their right pocket, circular or vendor financing. And this is actually very similar to what during the tech bubble 1.0 actually did as well, except it's a little bit more refined now. So it's a lot harder to catch when you're looking at accounting data. It's very hard to pinpoint and find these circular finance deals that are ongoing. But the issue is that when a company like OpenAI announces, well, we're going to promise to spend $100 billion on with AMD. And then it was like a promise deal that was like over 10 years that required certain benchmarks, but the headlines say, oh, AMD is getting like 100 billion from OpenAI, and that's really not the issue. And so what happens is the value of these companies skyrocket pricing in this growth that may not actually materialize or even materialize at the level that was originally announced. And so that's where these issues are in markets is that you get these massive valuations slash companies' values skyrocket, and all of a sudden you have this deterioration on fundamentals where you're looking at these companies making money and you're like, well, these numbers don't really justify whether the market cap of the company or the valuations of the company, via the sales or profit margins.
Okay. So even from that perspective, we would assume now that the investors are starting to get antsy about whether or not this was actually a good place to invest. And so maybe more anecdotally from your perspective, if an investor let's say Microsoft, for example, that had already put in billions into OpenAI and they realize that probably there won't be, it will take many, many years, if anything, or even not at all, to actually get that return back from OpenAI. Are they handcuffed? Is there anything that they can do at this point in time?
I think it's not going to play out really. The amount of money that's being spent is just so massive, and there is just really no signal of a like Steve Jobs iPhone kind of moment where you would have people aha kind of moment of whatever the product is that will get people to give people, buy the product and then those companies make money. And right now, I think really in a beta phase for all these LLMs. And they're still constantly improving them and they're still trying to figure out ways to make them more efficient. And now they're trying to create devices around them, but who knows if consumers or businesses want them. And so you have this infant age basically of a technology. But the issue is the companies aren't priced for infant failures. The markets are trying to figure out what product is going to be the product going forward to make money. And so it's at the infant stage of building something, but we don't really know what we're building towards yet. And so
Right.
that's why like Microsoft has Copilot. You hear, glasses. They're trying to do things with glasses, and Meta has glasses, and those aren't selling off the shelves. And so basically, there is no product, whether it's on the business level or on the consumer level, that can really stir demand to
Okay.
justify the growth, the return to just break even on all this investment.
Yeah, no, I agree with that. I want to reference something that you have said, and I want you to kind of explain what you mean by this. You said investors refuse to say this out loud. The most dangerous bubble stocks don't collapse because the business goes to zero. They collapse because the valuation was never grounded in a world where anything can be wrong, can go wrong.
Yeah, and so the issue is that when the market gets flooded with liquidity and interest rates are somewhat relatively low, and investors are looking for return on investment. And when it comes to technology and you see the shiniest object in the room, everyone rushes in to buy it because they think that they're going to get a massive return. And but that's exactly what happened during the tech bubble 1.0, which a lot of people forgot. And companies that were laying fiber optics, they were saying, oh, yeah, we're going to keep laying fiber optics. And as a normal investor, you would have thought, yeah, we need all this fiber optics for the future, for the internet, which was true at the time. So in 2000, that was
Mhm.
true. We need fiber optics, we need cables, things are going to go wireless. So we're going to need routers and we're going to need all this infrastructures. What happened was everyone got excited and they pushed these valuations of these companies so high that as soon as growth slowed, and remember, it doesn't even have to decline. As soon as growth slowed, because everyone was pricing in growth, everything basically collapsed on itself. And then as it was
Mm.
collapsing, it was then revealed that demand wasn't really there. And they were doing similar things like they are doing now, like channel stuffing, which basically means that companies were pushing their product but not collecting their cash flows. So that makes on a short-term basis their earnings look better, but eventually that lag of cash catches up to companies. And those are like warning signs and of a company and a story that we can kind of lean on as guidance to where we are today.
Hearken that artificial demand to like what even what's happening with NVIDIA because of the high inventory levels that it has on its chips. And yet its valuation continues to grow. And you would assume that it's actually running out of inventory because its sales are so high. And we know that that's actually not true. I want to tackle one thing that actually happened in the last week or so, and that is like the big deal between Apple and Google and the $20 billion agreement where Google pays Apple as a default engine for Safari. Now, This is huge, and this also has implications for OpenAI because not only do these two companies, one owns the search market, but both of them combined also own the mobile device market. So, what is your take on what this deal means for the market and especially for OpenAI and Microsoft?
I still think it's in the early innings for that, and we'll have to see how everything gets integrated and what is actually released and used. But I can say that Google definitely is one of the better companies that is firing on all cylinders. They're, to me, the most real AI company out of all the companies. And the reason why is because they're leaders in autonomous vehicles. They're the leaders. Gemini is pros rated consistently as top one or two of the LLMs. And obviously, they've reinvented their search platform, integrated it with AI. And they also own YouTube, which is one of the greatest profit machines that they have. And so Google's doing really well. Not really concerned about Google falling behind. Now, for Apple, though, Apple, they originally had the first LLM. Siri was supposed to be the LLM of the future when Steve Jobs bought Siri. That was his vision. And Apple, after Steve Jobs passed, they basically just focused on keep on squeezing the profits out of the iPhone and really lagged on innovation and on Siri. Siri went from something that everyone liked to do to like never wanting to use Siri. And so then think about it, ChatGPT was created in Apple's backyard, and you had all these investors dating back years ago building ChatGPT, and here Apple was wasting money trying to build like an EV car, which is known that they were trying to build an EV car that they wasted billions on. That got scrapped and is never coming to market. And now because they lagged behind LLMs, they had to find somebody to partner with. And then they went to Google. So they're going to incorporate Google's Gemini platform and then kind of integrate it into Siri. Apple is saying, we messed up. We didn't create anything. And now we're so far behind. We need someone to help us just get into that, just to get leveled onto the playing field. And so they went to Google versus all the other people. It's kind of like thinking about when Apple used Google Maps when they didn't have their own maps platform. And then eventually they had their own maps platform. And so this is basically Apple playing catch up. And so I still think it's very early to say what's going to happen, but basically we could kind of lean a little bit towards past references or history between Apple and Google and how those things played out to kind of like where we are today and where we're going to be going in the future.
So, one thing about Google, how does their balance sheet look?
Pretty well. And we'll get
Okay.
the updated, next week when they report earnings. So Google, they make so much money now with YouTube and ads. And then now they're growing with Waymo, and they're going to be doing a lot more with Waymo, possibly selling the technology. So there are very, very well financed. Not saying that the price of the value of the company can't go down, but out of all the tech companies, they're definitely one of the ones that are doing, the best overall.
I also hear that they're creating like a separate competitor to GPUs. They call it TPUs, but I haven't heard any buzz on whether or not they're actually investing in data centers.
As far as what Google, so they still use data centers, but the TPU is their version of the GPU, and so they want to cut out NVIDIA and have everything in-house. And Amazon's doing something similar with their Tritium chip that they've created, and
Okay.
so they want, Amazon and Google, they kind of all want everything to be on their own chips, servers, apps, and then kind of keep you in their ecosystem, and it keeps everything running.
Okay. So maybe the data center of today is similar to what the fiber optics
And
investment was.
that is something that, and I'll leave you at this. If demand for data centers were so big, CoreWeave wouldn't need NVIDIA being guaranteeing compute power, meaning like if compute from CoreWeave was so, if demand was so strong, then their cash should be soaring, their sales should be soaring, their debt ratios should be shrinking. But the real fact is they're having issues just getting demand. And so if we're having demand issues now already, that NVIDIA has to backstop CoreWeave. And the reason why they're backstopping CoreWeave is because CoreWeave is one of the biggest NVIDIA GPU buyers. And so if NVIDIA or if CoreWeave were to go out of business, then all of a sudden NVIDIA would lose one of its largest customers. And then therefore the whole thing would collapse on in this whole AI data center bubble. And NVIDIA has promised to buy compute power, even if like NVIDIA doesn't build LLMs. So why are they buying compute power from CoreWeave if they don't have LLMs? And so this really is the circular financing, vendor financing schemes of the 2000s. And that's why when I'm saying, well, if we're saying that AI demand is just starting, why are companies already having issue with their business models?
Yeah, I agree with that. Okay, I think that's all we have time for today. So clearly, we're headed at some point down into an economic downturn, whether or not it's going to be facilitated and accelerated because of this AI bubble. But how this all is going to play out in the AI industry will come to bear very soon. So thank you so much, Greg and Coastal Journey, for speaking to me today and your astute insights into some of these events. And for everyone else, please comment, share, like if you like this content. It helps me to define the types of stories to bring to you. It's reader supported, and I appreciate you stopping by. So until next time, thank you. I'm Hessie Jones.